Good afternoon, class. I'm going to go over a couple of brief exercises that I hope you need to watch before you attempt a quiz or the exam for the end of the three chapters. And so I'm using different software. I had issues with the previous one, so I'm just going to go over these entries instead of writing them out like I normally do. So brief exercise 13.2 is dealing with closing entries. And so, like always, step one, you want to pull out your data. And so the problem reads, at December 31st, Ortiz Corporation reports net income of $480,000. Prepare the entry to close net income. And so step one, pull out our data, $480,000 net income. Step two, what are they asking us to do? So here they want us to do a journal entry to close net income. And so at the bottom here, I prepared the journal entry. The date is December 31st. We're going to have debit to income summary and a credit to retained earnings. This is going to move the funds from income summary to retained earnings. You understand that income and expenses are closed to income summary at the end of the year. So that's why the funds are in income summary before you move them to retained earnings. Next, we have brief exercise 13.3. Issuance of common stock. So 13.3 reads, May 10th, Jack Corporation issues 2,000 shares of $10 par value common stock for cash at $18 per share. Journalize the issuance of the stock. So step one, you pull out your data. We have 2,000 shares of common stock at $10 par, sold for $18 per share. Step two, what are they asking us to do? We need to do a journal entry for the issuance of common stock. And so our journal entry is as follows. Anytime you have an issuance, you're receiving something and you're issuing something. Here we're receiving cash for the stock. And so May 10th, we received cash for 2,000 shares at $18 per share, which was $36,000. We need to do an entry to put the common stock on our books. And so that entry is going to be 2,000 shares at $10 par value. You always recorded at the par value, which is $20,000. Now, the difference in what we received as opposed to what we recorded on our books is going to be the paid in capital in excess of par common stock, which was $8. So it's 2,000 shares at $8. So it's a credit for $16,000. Again, that's 13.3. Moving on to 13.4, another issuance of stock entry. So 13.4 reads, on June 1st, Noonan Inc. issues 4,000 shares of no par common stock at a cash price of $6 per share. Journalize the issuance of the shares, assuming the stock has a stated value of $1 per share. So step one, we're going to pull out our data. We have 4,000 shares of no par common stock, $6 per share, and a $1 per share stated value. So step two, what are they asking us to do? We need to do a journal entry for the issuance. And so the journal entry is as follows. June 1st, we received cash in this situation, 4,000 shares at $6, which is $24,000. We're going to do a credit to common stock to put it on our books, 4,000 shares at $1 stated value instead of par, which is $4,000. And then the difference is a paid in capital excess stated value of common stock, 4,000 shares times $5, which is $20,000. So 13.4. The last exercise is 13.5, another issuance of stock. In 13.5, Lei Incorporated's $10 par value common stock is actively traded at a market price at $15 per share. Lei issues 5,000 shares to purchase land advertised for sale at $85,000. Journalize the issuance of the stock in acquiring the land. So here, step one, we're going to pull out our data. We have 5,000 shares of common stock at $10 per share. $15 per share is the market value, and $85,000 worth of land. Step two, they're asking us to do a journal entry for the issuance. So in this issuance situation, we're sending out common stock and we're receiving land instead of cash. And so we issued 5,000 shares of $15 common stock, which was accepted by the seller of the land at the value of $75,000 instead of the 85. So 75,000 is the value that we're recording it as. Again, we're going to credit common stock to put the stock on our books at 5,000 shares at $10, which $10 per share, which is $50,000. And then the difference is paid in capital excess of par common stock at $25,000. It's exercise 13.5.